Hey everybody, it's Adam Tracy, and following up on my last video about reverse mergers, right? The process of the backdoor IPO, going public through the simple merger with a public shell company. On the opposite end, you sort of have the reverse merger on steroids, which is a SPAC merger. And so what a SPAC is, it's a publicly listed company that is funded and is basically out there listed and looking for a merger partner, right? And in almost all cases, there's a few things that SPACs differentiate themselves apart. One, the amount of capital that is sort of residing there to further the business that they merge with. Two, the vertical that they're seeking to attack, like the industry, right? And then also three, the management and the degree to which they want to be part of the business going forward in a post-merger environment. And there's limitations depending on how the SPAC is operated in terms of like how long they have until they find a merger partner. If they don't, they have to return investor money, so on and so forth. But in the context of fintech blockchain, there are a lot of SPACs out there, and you see some of them, especially one that Cantor Fitzgerald had sponsored, which is looking at Securitize. And there's a huge advantage, but there's also some pitfalls, so you got to know what you're getting into. So one, it's the capital, it's the expertise, right? Obviously, like it's not just some guy who says, okay, raise the money, I don't know anything about fintech, merge, and then you're on your own, right? Because it comes at a cost, right? Like you can expect that with dilution, which I'll talk about in my next video, which is never an issue like in the token world, right, with IDOs, ICOs, and the like, because it doesn't really matter. But in the securities world, dilution is the whole thing, right? So you can expect to give up 20% at least of your entity in that merger, right? Like at the end of the merger with the SPAC, you've got control, you're in charge, your management, but you go from owning, your team like 100% to 80%, if not less. So that's the cost, right? Implicitly, outside of like losing that equity, there's a cost of being public, which is high. You've got quarterly reporting, you've got audits, which will just like drive you nuts because they're wildly expensive for what is ultimately not a lot of activity, especially if you're like pre-revenue. But that's just the problem with being a publicly traded company. It's not cheap. And you see like Trump like trying to make it so companies only have to report semi-annually and things like that, which is really how the rest of the world does it. And it would make the public markets far more efficient. And like the reason you do it, right? And I mentioned this in the reverse merger context. You do it for the liquidity, right? You do it for the liquidity because the valuation increases, right? And it's easier to raise capital. So one of the most common, forms of raising capital as a public company, and this probably begets its own video, is a PIPE, a private investment in public equity, right? So you'll see hedge funds, private equity, whatever, buying shares, okay, of a public company off market, right? So they'll invest directly. Those shares are restricted, meaning they cannot be immediately traded in the public market. There's usually a holding period of like 6 months, and that's a whole other thing. But they'll buy it at like a slight discount to the market, right? And then over time, which is, somewhat down the road, they can start liquidating if they're inclined to do so, right? But it's a great tool because unlike investing directly into a private entity, right? Like if you're holding private company stock, how do you make money? You cannot sell it, right? You have to hope and pray that the guys running the private company make money, right? And then issue a dividend, because legally they don't even have to give you a dividend, right? Unless you've got some crazy preferred stock. So at the end of the day, this is great because no matter how you're doing, good, bad, indifferent, if they want to liquidate after some, relatively small period of time, they can. So that capital is easily available, especially if you've got some sizzle and the stock is moving and trading. You've got a very liquid market. The more liquid the market, the lower cost your capital is a general postulate, right? So from the perspective of I've got this, fintech blockchain entity, I got to raise a ton of money. Well, instead of saying like, I'm going to go this guy, this guy, this guy, this guy, this guy, what I'm going to do is solve two problems at once. One, I'm going to merge with a SPAC that's got just basically a bank account and nothing else, right? ideally in my vertical where they've got the expertise, the connections, right, within the industry, plus like connections to capital markets, right, investment banks and the like, and private equity, whatever. And right now I've got the capital, I've got the connections, and now I've got the liquidity, right? So even if they abandon you, right, and you're trading because you got a nice, sizzle, you're in blockchain, fintech, the stocks are going through the roof. Guess what? You can raise capital, right? Because it's always going to be there. Like a public company that does not trade is the worst thing you can be in. You might as well be private. And I said this before because guess what? You're paying all this money to stay public, but you're reaping none of the benefit. And the benefit is that liquid market, right? And that's what attracts capital. So from the perspective of, is a SPAC merger the way to go? 99 out of 100 times, yes. Unless you've got something that's so groundbreaking, right, that giving up 20%, right, and obviously SPACs have different amounts of money, so it's always a no-brainer, right? Because if you go the VC route, look, Series A, Series B, you get diluted to nothing. First rule of venture capital is fire the owner, right? You're gone. By the time you go public, yeah, fine, you got a really high valuation, but you own like 5% of the company. SPAC, you're public and you save yourself time. If you wanted to go IPO, right, between the roadshow and then filing with the SEC, right, the roadshow could be a year. Filing with the SEC, 3 to 6 months. Then you got to go through FINRA, right, and all this kind of stuff. So it can be an 18-month process if you do it organically. Plus, you got to do all the work to raise the money. Here you don't, right? So you're saving time. You have immediate access to capital. The cost, 20%, and then you have a long-term pathway to raising additional growth capital by virtue of being public, provided you act like a public company and actually disseminate news, be responsive, get the stock trading, and all that stuff. So that's my take on SPAC mergers, especially as it relates to fintech, blockchain, startups. If you have any questions, need to find one, need to understand it, maybe think it's right for you, wrong for you, want to start a SPAC, hit me up, Adam at adamtracy.io. Talk to you next time. Cheers.